Okay, have you ever really stopped to think about what gives your money, actual value? Or what happens to that loan document, that promissory note, after you sign it and hand it over? Today, we're doing a deep dive into a really key moment, one that's often misunderstood in U.S. financial history. March 9th, 1933. We're going to try and unpack the real nature of the, quote, new money Congress brought in back then and how it totally changed the banking system, right down to the notes you might sign today. Our mission really is to pull out the key bits of info from congressional records, laws, legal ideas, just to help you understand what's actually going on sort of behind the curtain of our money system. And this isn't just, dry history. It's about maybe challenging what you think you know about debt, about currency. Okay, let's unpack this. So to really get this, we have to go back to 1933. Pretty desperate times, right?
Oh, absolutely. Deep in the Depression.
Yeah, FDR had just taken office. The banks were in crisis, total chaos. And Congress moved fast. Emergency Banking Act, March 9th. This was a huge moment, a really fundamental change for the whole U.S. financial system. So what was the first big thing? What was this new money they introduced?
Well, that's the first kind of surprising point. The new money people talk about from that act, it wasn't the Federal Reserve notes themselves, the bills in your wallet.
It was in the paper money.
Okay. And then what was it?
It was the collateral. The stuff that was going to back the Federal Reserve notes. Section 401 of that Emergency Banking Act, it explicitly amended the Federal Reserve Act, and it basically said gold is out as the reserve base. Gone.
Gold is out. Wow. So if gold's out, what's the new gold? What was this new collateral then?
Good question. It was defined as direct obligations of the United States. Think Treasury bonds, T-bills, that sort of thing. And this is key. It also included notes, drafts, bills of exchange, or bankers' acceptances. Commercial paper, basically.
Okay, so government debt, commercial paper. Exactly. And there's this pretty striking quote from the Congressional record of that very day. It gives you a sense of the thinking. It says, the money will be worth 100 cents on the dollar because it is backed by the credit of the nation. And then it says, it will represent a mortgage on all the homes and other property of all the people in the nation.
Wait, hang on. A mortgage on all homes and property of everyone. That sounds immense. Really.
It's a powerful statement, isn't it? It shows how fundamentally they were shifting the foundation from gold, a tangible thing, to something less obvious, the nation's credit, backed by, well, everything.
Okay, so that's the backing, the new gold. But if the Federal Reserve notes themselves aren't the new money, what gives them value? Are they? Are they just paper promises then?
In a way, yes. They're better understood as representations or claims against that new money, against the collateral. They don't really have intrinsic value on their own. It all relies on the backing.
Right. No backing, no value.
Precisely. And this isn't just, theory. It's written right into the law. 12 U.S.C. sections 411, 412, 414, they lay out the rules for issuing the notes and what has to back them. Even the Treasury, fairly recently, 2011, acknowledged that FRNs need collateral to have value. It comes back to that old legal idea, nihil dat quod non habet. You can't give what you don't have. The Fed can only issue these notes because it holds the specific assets defined back in 1933. Its authority is tied directly to that collateral.
Okay, I think I'm following. Now, let's connect this to everyday life. This is where it gets really interesting, I think. How does something like, say, a promissory note for a mortgage fit into all this?
Yes. This is where the understanding really shifts quite profoundly.
Because normally you just think, okay, I signed this, it's my promise to pay back the bank. Simple, right?
That's the common understanding, yes. But under this framework, when that promissory note you sign gets delivered into the Federal Reserve System, maybe to the Fed itself or just an agent bank, its function changes. It stops being just evidence of your personal debt. It becomes what's called eligible paper.
Eligible paper, meaning?
Meaning it qualifies under the rules, specifically 12 U.S.C. Section 347, which lists promissory notes to be used as collateral by the Fed system. It actually becomes part of that collateral backing Federal Reserve notes.
So my promise to pay becomes the backing for money.
In essence, yes. And there's more. The Fed's own internal rules, their operating circular number 10, sections 3.2b and 14.2, they state these notes are held as pledged collateral. They're kept in a restricted account. And get this, they're often over-collateralized, sometimes by huge amounts, maybe up to 900%.
900%. So let's say I sign a note for $100,000. That could potentially back $900,000 in Federal Reserve notes circulating out there.
That's the potential implication of the over-collateralization rules, yes. It's quite staggering when you think about it.
So just to be crystal clear, When I sign that note and it enters the Fed system, its whole legal character just transforms.
That's the core argument here.
Yeah.
The process essentially extinguishes its function as a promise to pay. In the conventional sense, the note becomes an asset to the Federal Reserve System.
An asset. Wow. Okay.
Yeah.
So if the note becomes collateral, an asset, does a bank, like my local bank, actually lend me money in the way I think of lending? Or is something else going on entirely?
Well, based on the Federal Reserve Act itself, it looks more like an advance than a traditional loan. The Act actually uses the term borrower very broadly. 12 U.S.C. sections 347 and 347C, they allow any Federal Reserve Bank to make advances to individuals, partnerships, corporations, using their promissory notes. And there was even a presidential proclamation, number 2039 from March 6, 1933, right before the Act, that defined banking institutions super broadly. It included basically anyone dealing in discounting business paper.
So individuals, small businesses,
Yeah.
not just big member banks.
Right. It put everyone sort of on the same footing for getting these advances based on their notes.
Okay, so it's an advance, not a loan. What's the mechanism? How does the money, appear?
The key is in 12 U.S.C. section 412. It says Federal Reserve notes are obtained by an exchange of eligible paper at par. At par, dollar for dollar. It specifies the collateral shall in no event be less than the amount of the Federal Reserve notes applied for. So you provide the note, the eligible paper, and you get an equivalent value advance in Federal Reserve notes, or more likely, credits.
A dollar for dollar exchange, my note for the funds.
Exactly. So the depository institutions, the banks, they receive these advances from the Fed system based on the notes they submit. They aren't really originating lawful money loans from their own reserves in the old sense. And it's important to remember, those book entry credits that appear in your account, they aren't technically legal tender. That term, under the law, 31 U.S.C. 5103, only applies to physical coins and currency.
So the bank isn't lending me its depositors' money or its own capital. It's acting more like a facilitator, taking my note, exchanging it within the Fed system for the advance, which then becomes the funds I receive.
That's a good way to put it. It fulfills basic contract law principles, too. Like ex nudo pacto, non oritur actio, no action comes from a bare promise, and quid pro quo, something for something.
Ah, so the something is my note.
Precisely. The delivery of your promissory note is the something for something. It completes the exchange for the Federal Reserve notes or credits. The transaction is arguably complete right there.
Okay, this interpretation is pretty radical compared to how we usually talk about loans. But what about other laws? Like the Uniform Commercial Code, the UCC, doesn't that govern notes in contracts? Or Supreme Court cases that define what a security is? Surely they come into play.
That's a really important question, and the answer lies in understanding which law applies where, and crucially, congressional intent from 1933. First, the UCC. Well, the Emergency Banking Act of 1933 came before the UCC was even drafted and adopted.
Right, timing matters.
It does. And the Federal Reserve Act is the specific federal law governing these particular transactions and instruments within the Federal Reserve System. The UCC itself actually says, in Section 1103B, that it generally applies only to transactions intended to be governed by it, and it doesn't override other specific statutes unless intended.
So the Federal Reserve Act, being specific to this system, takes precedence here.
That's the argument. Congress set up a specific framework for monetary instruments under the Federal Reserve Act. Now, about that Supreme Court case, Reeves v. Ernst & Young from 1990. That case established the family resemblance test to decide if a note is a security under the Securities Exchange Act of 1934.
Okay.
But that test and that act are about investment securities. The argument here is that the Reeves test is simply inapplicable to promissory notes when they function as collateral under the Federal Reserve Act.
Why inapplicable?
Because Congress, back in 1933, already defined how these specific notes function within the monetary system created by the Federal Reserve Act. They defined them as monetary instruments, as collateral, not as investment securities subject to the 1934 Act. There's a legal maxim. The intention of the legislature is the law itself. And another, no court may override the plain language and intent of Congress, especially when Congress has created a specific definition within a specific statutory scheme.
So Congress's definition in the 1933 Act for this specific purpose stands, regardless of later laws or court tests about different things like investment securities.
That's the essence of it. Congress defined these notes as the new gold collateral within its monetary system framework.
Okay. Wow. Let's bring this all together then. This is where it gets really practical. What does all this mean for you, the listener, if you're maybe facing a claim for an outstanding balance on a mortgage or maybe even foreclosure?
Well, the direct conclusion following this line of reasoning is quite stark. If your promissory note was delivered into the Federal Reserve System as eligible collateral,
Which seems to be standard practice.
right, then arguably there is never a genuine debt in the ongoing sense we usually think of. Why? Because the delivery of the note was the exchange. It was the quid pro quo for the Federal Reserve notes or credits advanced. The transaction was completed at that point.
Completed. Meaning the debt was effectively settled by providing the collateral note.
That's the implication, which would mean any later claim by a depository institution for an outstanding balance based on that same note could be seen as legally false. It might lack legal merit because the note's function as a promise to pay was arguably extinguished when it became collateral.
And foreclosure, if there's no outstanding debt in that sense.
That's the critical point. If this interpretation holds, the non-judicial foreclosure proceedings, the kind that happen outside of court that perceive as if there's still an ongoing debt obligation based solely on that original note, well, they could be seen as fundamentally flawed. They might be ignoring the note's actual function as collateral and the potential extinguishment of the obligation through that initial exchange. This could potentially violate fundamental constitutional rights.
Which rights are we talking about?
Things like the right to contract clause, the Fifth Amendment's protection of property, the right to property clause, and perhaps even the right to trial by jury if the nature of the obligation is disputed. And again, some powerful legal maxims come to mind here. A law repugnant to the Constitution is void, or fraud vitiates everything it touches. And maybe most relevantly, an obligation extinguished by legal performance cannot be revived by implication.
So if the delivery of the note was the legal performance, you can't just pretend it didn't happen and keep demanding payment.
That's the logical extension of this entire framework, yes.
Wow. Okay. So just to recap this deep dive, we've basically traced how one act of Congress in 1933 might have completely flipped the script on what money is, what a promissory note really does in the system, and even what debt means. It's genuinely mind-bending to think that the note you sign, your promise, could actually be the new gold that settles the transaction rather than creating a long-term debt you still owe in the traditional way.
It definitely challenges core assumptions. So maybe a final thought for everyone listening. Consider how this foundational view, this potential legal function of your promissory note within the monetary system stacks up against everything you've assumed about your financial agreements. What does it mean for your understanding of contracts, of obligations, and how might that, change how you look at things moving forward?
A lot to think about there. We really hope this exploration, digging into the actual legislation and records, has maybe shifted your perspective a bit on the financial world we all operate in.